Hello guys, welcome to my channel B Square Trend. In this video, I will try to explain about some important ratios which we need to consider while analyzing fundamentals of a stock. So what are those ratios? Here are the top 5 and most important ratios which we need to consider for fundamental analysis of a stock. So the first one, price to earning ratio, that is PE ratio. Second one, interest coverage ratio. Third one, price to book ratio, that is PB ratio. Fourth one, debt to equity ratio, that is DE ratio. Fifth, price earning to growth ratio, that is PEG ratio. Now we will see what each ratio depicts and what value of ratio is good to consider while buying a stock. We will see what is PE ratio and how to calculate it and best level to consider. PE ratio is the ratio of a company's share price to the company's earning per share. The ratio is used to determine the value of the company. It will be very useful to find out whether the stock is overvalued and undervalued. A high PE ratio could mean that a company's stock is overvalued. A low PE ratio could mean that a company's stock is undervalued. Here is the formula to consider the PE ratio, that is market price of a share by earnings per share. The best level to consider the PE ratio is 10 to 15. If it is more than 15, then it is overvalued and be cautious. If it is less than 15, it is good to consider. Now we will see what is interest coverage ratio and how to calculate and what is the best level to consider. The interest coverage ratio is used to determine how easily a company can pay their interest expenses on outstanding debt. Here is the formula to calculate the interest coverage ratio. Earnings before interest and taxes divided by interest expense for a particular period of time. It should be more than 2 or 3, then the stock is good to consider to buy. If it is less than 1, totally avoid it. Lower the interest coverage ratio, higher the debt burden. Now we will see what is PB ratio and how to calculate PB ratio and what levels to consider this PB ratio. The PB ratio is calculated by dividing a company's stock price by its book value per share. Book value is defined as its total assets minus any liabilities. The low PB ratio can be indicative of underlying stocks. Here is the formula to calculate the PB ratio, that is market price per share to book value per share. If the PB ratio is less than 2, then we can consider the stock to buy. Now we'll see what is the debt to equity ratio and how to calculate and what is the best level to consider. It is considered as how much debt you owe for each stock you hold. The debt to equity ratio is calculated by dividing a company's total liabilities by its shareholders' equity. Here is the formula to calculate the debt to equity ratio, that is total liabilities by total shareholders' equity. The debt to equity ratio should be less than 1. Now we'll see what is PE ratio and how to calculate it and what is the best levels to consider. The PE ratio is used to determine a stock's value and the company's expected earnings growth. And here is the formula to calculate the PE ratio, that is PE ratio by earnings per share growth. If the PE ratio is less than 1, then the stock is considered to be good to buy.